Oh, hi there. I'm Max Keiser. This is the Keiser Report. A lot of people talk about Ponzi schemes, but do people really know what a Ponzi scheme is? Stacy?
Well, of course, we've been talking about Ponzi schemes because you can't taper a Ponzi, and that was attempted over the past year with quantitative tightening and interest rates rising. Obviously, that has all fallen apart, especially in Europe, where we have 15 trillion in negative yielding debt. It went up by over 600 billion in one day just in the past week. And now I want to look at a headline about the unthinkable becoming thinkable. Of course, it's always been thinkable here on Keiser Report. We always think outside the box. But here in the mainstream media, they're saying, could Treasury yields ever fall into negative territory? Investors are wondering whether U.S. Treasury yields might follow the trend witnessed in Germany or other sovereign markets and eventually fall into negative territory. The unthinkable is now thinkable. Of course, this is the German yield and this is the U.S. 10-year yield. And as you see, since basically the European Union finally began quantitative easing in earnest, they've gone into negative territory.
I tell you what's remarkable is that, we made a film like 10 years ago about the collapse of Iceland. We went to Iceland about 9 months before it collapsed and predicted that it would collapse because it was this huge Ponzi scheme where the banks were lending to speculate, and the result of that speculation in the housing market would be used as collateral at the bank to create more lending. So it became a huge Ponzi scheme. Of course, it collapsed. Now, when people talk about these negative interest rates, they think it's the result of some policy by someone in doing some economic benefit. What they don't understand is that it's the biggest bubble in history. The sovereign bond bubble is by far the biggest Ponzi scheme bubble that's ever been created in the history of the world. And when you talk about these sovereign bonds trading at negative rates, that means the price of the bond is at 3,000-year highs. That's how extended this bubble is. And how does it get there? It's because the banks are lending against the Ponzi value of the bonds to leverage more buying of those Ponzi extended bonds. And of course, like Iceland, this will result in a 98% collapse.
Never in the history of the world until 1971 did the human race ever engage in an all fiat currency commerce trading settlement system. i.e., we've always had gold-backed currencies or some other hard asset. That's why nations went bankrupt all the time. That's why many wars happened, is because France would go bankrupt. They would have no gold left or something like that. So now we have just an infinite regress of ever referring to another contract or another fiat currency printed by something backed by we don't know what, except for perhaps the mightiest army that has ever stalked and threatened the earth. And that's what we have now. So that's why they could go, they believe they could do this.
Right. I mean, it's a good point that up until 1971, there was always at least one currency in the world that had a gold backing. The Bretton Woods Agreement that was after World War II set the American U.S. dollar up as a currency that ultimately had a settlement in gold. And then that was stopped in 71. Then you had fiat currencies referring to other fiat currencies. And that's how you ended up with a global Ponzi scheme. And you had, as Nomi Prins writes in her excellent book, Collusion, about how the central banks then were no longer competing with each other in a mercantilist system, but became their co-conspirators in a global monetarist system where each bank was simply passing the hot potato around the world. And there was never any moment when interest rates were not being cut over the past 45 years. That's never happened. One country may have raised a bit, but another country would have dropped by considerably more. The net result is now the globe is, the debt to GDP for planet Earth is approaching 350%.
Well, some say that the U.S. dollar has been backed by oil, so it always has been backed by something hard, that, even though it's liquid oil. The other thing that we're seeing, however, is as Dr. Michael Hudson, an economist who used to work at Chase Manhattan, and when he wrote his PhD, he told us that, he told his bank and he told his professors that actually unlike what you say, banks don't actually lend to businesses. They lend for mortgages. So our entire economy, our financial system, everything is backed by mortgages. So we're going to get to that because this is, remember when during the French Revolution, we had the currency backed by property of the confiscated Catholic Church properties. So, and what do we have there but hyperinflation as people demanded the prices keep on going up, right? Well, here we have Denmark, which Denmark, by the way, is one of the most household indebted of all OECD nations. So their debt to income is 280%. But Denmark's third largest bank is now paying people to take out a mortgage. What this means is that if you buy a house for $1 million and pay off your mortgage in full in 10 years, you would pay the bank back only $995,000. No mortgage payments would be due between the purchase and payoff date. So effectively, a borrower only has to repay principal with a small discount, guaranteeing that the bank loses money on the loan, and that's a negative 0.5%.
Right, and again, what's amazing and ironic about this is that the bank doing this is Danske Bank, and that's...
this is actually Jyske Bank.
Okay.
I do have a report from Danske Bank that I'm going to get to, but this is from Jyske Bank. It's the third largest bank. Danske Bank is the largest bank in Denmark.
Right, and referring back to that film we did about Iceland, and I think it was 2008, about the Ponzi scheme there, Danske Bank was the one who initially put out this report suggesting that Iceland was a Ponzi scheme about to implode. Now in Denmark, as you're pointing out here, they're using the exact same technique of using the hyper-leveraged mortgaged real property assets as collateral to create this enormous Ponzi scheme. So the negative interest rates are a reflection of a Ponzi scheme, not as economic policy. And yeah, you might end up having zero mortgage and the bank paying you 0.5% a year or 1% a year. But let's keep in mind that the value of the property itself, if it drops 50, 60, 70, 80%, that's not a good deal.
Again, let's go back to the fact that we have this system that is unique post-1971, all fiat, but at the end of the day, they have to back it by something, whether it's the military, whether it's oil, whether it's property. And in revolutionary France, when they had property, the assignat backed by property, basically the reign of terror followed because people, it went totally mad once the whole thing collapsed. Here you have the same thing. It's also similar to 1933 when the U.S. started confiscating gold because we were in the midst of a global Great Depression. We were having the same sort of currency wars. It was beggar thy neighbor policies. Here, it's confiscating wealth because how is the bank paying these speculators essentially to buy overpriced housing? Overpriced essentially, especially because of their incomes, which are not rising. So how are they doing that but transferring it from savers to these speculators? And here's the quote from the chief economist. Speaking of Iceland, of course, we spoke to the chief economist at Kaupthing Bank, and he had an explanation for why Iceland, this tiny little nation of 300,000 people, was buying up all of Europe, major income-producing assets, because he said they were 3 times as mighty, that the workers were 3 times more productive than any other European worker, even the Dutch or the Germans or the Finns or anything, right? So here's their economist from Jyske Bank, which is offering this mortgage. It's another chapter in the history of the mortgage, he says. A few months ago, we would have said that this would not be possible. But we have been surprised time and time again, and this opens up a new opportunity for homeowners. In practical terms, the negative rates will act as a subsidy to the repayment, and the repayment portion will become smaller and smaller as the debt is reduced, he said. Yes, I hardly understand it either. In fact, I said it can't happen, but we have figured out how to make a negative rate mortgage.
Okay, right. So as you point out, similar to the gold confiscation of the 30s, this is another wealth confiscation scheme. In Switzerland, and I think it's UBS, if you have a large sum of cash at the bank, they charge you a negative 0.75% to store your cash at the bank. It's a negative interest rate. So the bank is taking money out of your account every year to the tune of almost 1%. They don't pay you to have your money at the bank. They take money away. Now, with a negative mortgage, that money is going to a mortgage buyer. So they're confiscating wealth from savers and they're giving it to property speculators because the banks have always made their bones in property lending. Their balance sheets are heavy with property, and if they were forced to market the value of that property, they would all have to declare insolvency. So to keep their fee stream going, they are engaged in guaranteed property loss mortgages. Your property will lose catastrophically with these mortgages because it's a 3,000-year bubble. At the same time, your savings are being confiscated by negative interest rates at the bank. So, okay, Switzerland and Denmark are two different countries, so they're not doing it in conjunction. But as this plague of this Ponzi scheme becomes bigger, all banks will coordinate because they're all colluding, as Nomi Prinz writes, in collusion.
Well, in terms of beggar thy neighbor, this is the problem globally now is under beggar thy neighbor, some countries actually produced and manufactured and created things like most countries did, and they had their own economy and they were competing with each other. Now it's one giant global Ponzi scheme where all of these contracts, all these fiat currencies, all these derivatives reference each other and nobody knows where it ends. So they're all engaged in this crazy. I mean, here's the chief economist going, we don't know how we did it, but it's working. Here, also you look at the fact that globally it's a global fiat currency system backed by the US dollar, and you see the advantage to that versus Europe, because Europe can't print like the United States can. So here in Europe, they do have to resort to wealth confiscation. So the negative interest rates in Europe are driven by the ECB first, who drives those sovereign bonds negative and then forces the pension funds to transfer their wealth to these negative yielding bonds. But back to Danske Bank. This is a report from November 28th, 2018, and here is what they said. Danish households are resilient despite record levels of debt, they argued. Danish households have one of the highest gross debt levels in the world. However, that is only one side of the equation, explains Danske Bank's private economist Louise Agerström Hansen. He says, standing at 280% of net disposable income, no other OECD has more indebted households than Denmark. However, that is only one side of the equation, as high debt loads are balanced by large assets, he says, the property.
Right, that's used collateral to leverage a system in an enormous Ponzi scheme. Denmark is the new Iceland. Okay, that's almost a dead certainty at this point.
We're all the new Iceland. Canada, Australia, New Zealand, Hong Kong, all of these nations they're all relying, just as the revolutionary French did, on basically an assignat. This is what we have, is a global assignat of infinite regress.
All right, well, much more coming your way after the break. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Karl Denninger of market-ticker.org. Karl, welcome back.
Thank you, Max.
All right, as always, when things get into an area that nobody seems to really understand, we talk to Karl Denninger, who seems to figure it all out and give us his latest on the news happening around the world. Karl, we have $15 trillion in negative yielding bonds in Europe. This has recently been climbing at a rate of $1 trillion per week. Is this anyway normal? What should people understand is happening, Karl?
It's forced inflation. I mean, what is inflation? It's the destruction of purchasing power, right? I mean, that's the definition of it. So what is a negative yielding bond? It's a forced inflationary instrument. If you buy it, you're guaranteed inflation in the amount of the negative yield.
Right. So is it part and parcel of what could be called an enormous bubble in the bond market? In other words, people focus on the yield part, but if you look at the price part of a bond, the bond price is trading at multi-hundred-year highs. It's even trading at multi-thousand-year highs. And that seems to be the most overextended bubble in any financial market. Karl, what do you think?
Well, of course. I mean, the reason you buy a negative yielding bond is obviously not for return of your principal, because you're not going to get it all back. You buy it because you think the price will go even higher, and then you can sell it to some other sucker. But that means that you think the yield's going to go even more negative.
just to kind of delve into this inflation and deflation, if you have a sovereign bond with a negative coupon, that is to say negative interest rate, you are in fact destroying capital, which on one hand you could say is deflation. But so how do you help walk us through the definitions of these two words as they relate in this instance?
The reality of how monetary process actually works, as opposed to what the Jerome Powells of the world would like you to believe, and the Lagardes and everybody else, Draghi, is that if a government is issuing more in sovereign debt, then their GDP is expanding in nominal terms. So, for example, if you have a 3% GDP expansion and you have a 4% fiscal deficit, you are running a 1% fiscal inflation rate. That's because you are issuing more debt and more money into the system than your economy is growing. So in real terms, the consumer, the person who is using those funds, is losing money every year. If you then have negative interest rates on those government bonds, what you're essentially doing is creating the excess space for the government to run that fiscal deficit. It's just part of the same scam of running deficits in excess of GDP expansion to begin with, which nobody in any civilized nation should allow to happen. Should be an instant revolt when it occurs, because it's theft on a scale of that differential from everybody in the economy. But, if you do that to too large of a degree, you look at what happened in Greece, right? They ran huge fiscal deficits in excess of GDP. And ultimately, people threw up their hands and said, okay, enough of this. And everything all came down crashing around their ears. So to try to prevent people from having that reaction, the ECB and the JGB and these other nations have gone to this other mechanism. And it'll work until it doesn't, just like it did in Greece and Italy and in Spain.
All right, very good. Now, Karl, we asked economist and economic historian Dr. Michael Hudson if there had ever been negative rates seen in history. He said not to his knowledge, and he's gone all the way back to the Bronze Age and never found it. So it's quite an unusual development. What does the future look like if the entire world goes negative in this way, Karl?
I don't know that anybody knows. If you asked me this 10 years ago, I would have said this isn't going to be able to happen because you won't be able to sell them. But obviously that's not the case. We have all these trillions of dollars worth of them, and people are buying them. But again, I think the real answer is that where you're seeing these is in the longer dated instruments. And the reason that they're being bought is because they're not really bought. They're used as trading vehicles. So you buy a negative yielding 10-year bond, and essentially what you're doing is betting on the come that the yield on the next one that's issued will be more negative, and therefore the price of the one that you bought will go up, and you can sell it and make a profit. That's like any other bubble. If I buy a piece of commercial real estate, not because I want to build cars in that building, but because I think that the price will go from $5 million to $7 million, and I'm expecting to make a $2 million capital gain on the transaction. And that's the entire motivation for doing it. That's sustainable right up until the first handful of people buy the $5 million building and find out that when they go sell it, they only get 3.
Right. So there's kind of 2 dimensions to this. There's the vertical fraud, which you could look at interest rates, and then there's the horizontal fraud, which would be maturity date. And on that score, we've got proliferation of 100-year bonds. Austrian 100-year bonds soared 80% in the past year. The question is, has time lost value, or is the future really looking that bleak, that far out, Karl?
Yeah, and I think the reason for extending maturities like that is that it allows that, buy it today and expect the yield to be more negative tomorrow to go on for a longer period of time. I mean, let's face it, the gap between the actual cash value of a bond and the discounted cash flow value narrows as time to maturity gets closer, right? I mean, that's just the way bonds work. So if I issue a 100-year bond, I have an awful lot of time for that game to play out. The problem with doing it from a sovereign point of view is that the discount, if those yields ever go positive, goes up dramatically. And so now all of a sudden I've got an obligation to pay interest for that period of time. And while I can try to buy them back, at what price?
Right. Let's talk more philosophically for a moment here. So on the surface, the GDP and stocks look relatively fine. How much of this is about fear of a major paradigm and power shift, the decline of U.S. power, and perhaps also the end of the current global fiat currency grid? So I guess the question is, underneath what on the surface looks to be one set of reality, the GDP numbers, the stock market, underneath there seems to be brewing a potential paradigm shift. And by that, we're talking about the whole fiat currency grid, because everything you're talking about right now wouldn't be possible unless we had a global economy that worked on fiat currencies whose value is based on reference to other fiat currencies. So you have this system of infinite regress, where the euro is valued based on the dollar, valued based on the yen, based on the pound. There's no actual underlying, for example, a gold standard. So, but are we coming? It's been a 37-year bull market in bonds. We've had neoliberalism since Reagan and Thatcher. Are we at an inflection point? Are we on the verge of a major shift, a major paradigm shift? I know it's a bit of a philosophical question. What do you think, Karl?
I think we're headed more for a major sort of collapse in sorts, in that we started out with this essentially after World War II. America was pretty much the only manufacturing power left in the world. We blew all the rest of them up. And so we had a tremendous advantage, not so much because we were better than anybody else, but because we were the only ones that still had any factories left. Those have now gotten rebuilt. We had a lot of repression through the 1950s by the Federal Reserve. It's part of why they thought they could get away with it over the last 30 years or so, is that they did it in the 1950s. They forgot that when they got away with it in the 1950s, the reason they got away with it was, again, everybody else was blown up, okay? So as we've gone forward, corporations have lobbied governments to do things that give them advantages that they couldn't otherwise have. In the United States, we've seen this on both ends of the curve, on the labor curve. On the low end, you have 20 million plus illegal immigrants in this country who are here specifically because they can be abused by employers, and that lowers their costs. Okay. On the other hand, you have the H-1B holders who, it certainly appears, the government fraudulently argued that this was a diversity operation, when in fact what it really was suppressing wages for people with a lot of skill and a lot of ability. So you have the squeeze on both ends of the bell curve of human capital that it accrues to the top 1/100th of 1%. And the government does this and goes along with it because it wants to be able to spend in deficit. And the only way to do that is to squash both sides. Otherwise, if you have to pay a computer programmer $150,000 a year because that's what the market demands for that skill, instead of $40,000, you get instant wage push inflation and rates go up. And the Fed can't ignore that. And so, we have to prevent that from happening. So what are we going to do? We're going to bring in a bunch of Indians on H-1B visas that make $30,000 a year, and they live 6 in an apartment. And so this has been going on all over the developed world. We claim that there's a Chinese miracle. There is no Chinese miracle. We just offshored the pollution to China. And Foxconn, employs children, threatens them, and has to put nets up around their buildings because people get so despondent over the working conditions, they try to commit suicide. I mean, at some point, this breaks, okay? And Max, what we've seen now is that governments are getting to the point where they're literally putting out negative interest rate bonds as a way to try to extend the bubble one more turn of the crank. Well, you can do it for a while, but at some point, this will stop working. And I think we're getting to the end of that.
Right. Now, to get back to this inflation point, we're talking about inflation, the existence of inflation, which is everywhere except wages, right? So this is the miracle of the 21st century, is that financial engineers have engineered away wages in their economic models. And that's part of the problem. We have about 30 seconds left. On your thoughts on gold. Central banks have begun buying gold in greatest amount since we were on the gold standard. We got about 30 seconds. What do you think?
Well, they've done an awfully good job at suppressing, price signals. But if you look at if you want to play a bubble, you don't want to be in gold. If you want to play a bubble, you want to play common stocks. That's what the data says. I just don't know when it crashes, and when it does, I don't know that you're going to see gold go up in price.
All right, fair enough. Well, we're going to have you on for a second segment to pick your brain some more over there at the Karl Denninger headquarters. I like all those screens in the background. It's very reassuring. Thanks for being on the Keiser Report.
Thank you.
Well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Karl Denninger of market-org. If you want to catch us on Twitter, it's Keiser Report. Until next time, bye, y'all.